Joe Ross's approach resonates with seasoned traders seeking durable, logical strategies, not quick fixes. His focus on spreads and seasonals is grounded in market realities, offering a systematic edge. For those who've experienced the stress of outright trading, the appeal of mitigating risk through predictable patterns is immense. Ross's teachings refine your approach, adding consistency and reducing emotional swings. This isn't for beginners. Ross assumes you understand market mechanics and the pain of positions moving against you. The value lies in methodology, exploiting high probability relationships between related instruments, not guessing market direction. Spread trading shifts the focus from battling the market to trading relationships, allowing for more strategic, less stressful planning. It's a business-like, chess-like approach. Setup is as important as execution. Ross provides a blueprint for integrating spreads and seasonals into your toolkit, diversifying strategies for all market conditions. Spreads thrive even in sideways or choppy markets where directional trades fail. Combining structural and seasonal advantages creates a robust, time-tested framework. This is about building a sustainable trading career, not chasing the next big move. For professionals, it's a method to refine your edge and operate with greater control. Ross's philosophy is about long-term consistency, not short-term excitement. A spread trade is the simultaneous purchase of one futures contract and sale of another related contract, either different months or related commodities. The goal isn't to bet on price direction, but to profit from changes in the price difference between contracts. This structure reduces risk gains on one leg, often offset losses on the other, lowering volatility and margin requirements. Lower risk doesn't mean no risk. The spreads differential can still move against you, and liquidity can be an issue. Careful order placement is essential to avoid slippage. The real power of spreads is precision. You're isolating a specific market opinion, not making broad forecasts. For example, you might bet that the premium of new crop soybeans over old crop will decrease after planting. This transforms trading into a micro-analysis of supply and demand between 2 points in time. Spreads allow for systematic, testable hypotheses, ideal for applying seasonal analysis. These relationships often show more reliable patterns than outright prices. You're trading a less followed instrument, which can be both an advantage and a challenge. Ultimately, spreads offer a more focused, lower risk way to express market views. This precision is what makes them so valuable for experienced traders. Profitable spread trading starts with a clear, data-driven hypothesis, often based on seasonals or fundamentals. For example, in the soybean crush spread, you buy meal and oil futures, sell soybeans, and aim to profit from the widening margin. Use spread orders, not separate orders, to avoid legging risk. Enter both sides at a specified differential. In a calendar spread, like buying May wheat and selling July wheat, analyze the spread's historical chart, not the individual contracts. Look for recurring patterns and time your entry when the spread confirms your seasonal thesis. Manage trades based on the spread's value, setting profit targets and stops on the differential. Ignore the noise of outright prices. Focus on the relationship you're trading. Exit when your target, stop, or seasonal window is reached. Discipline is key. Trade the relationship, not the headlines. Seasonality means certain price patterns repeat at specific times, driven by recurring supply and demand cycles. In agriculture, planting and harvest create predictable price swings. Energy and financial markets have their own seasonal tendencies. These are statistical edges, not guarantees. External shocks can disrupt them. Use seasonality as a filter, not a standalone signal. Combine it with chart and spread analysis for confirmation. Seasonality narrows your focus, letting you target high-probability setups at the right time. Instead of scanning hundreds of charts, you zero in on the best opportunities. This proactive, systematic approach is the foundation of a robust trading plan. Plan trades weeks in advance, not on impulse. Seasonality is your roadmap. Use it to guide your research and execution. Identifying reliable seasonal patterns requires a systematic, data-driven process. Start with historical data. Seasonal charts show average price movement over years. Look for consistent periods of drift, then verify by checking year-over-year data for reliability. Aim for patterns with at least 80% historical consistency. Analyze the spread itself, not just the outright contracts. Context matters. Check if current price action aligns with the seasonal pattern. The best trades occur when history and current action are in harmony. Use seasonals to know when to look, but let the chart confirm the setup. This disciplined process filters out weak trades and focuses on high probability opportunities. The genius of Joe Ross's method is combining spread trading with seasonal analysis for a powerful synergy. Spread trading isolates relationships and reduces noise. Seasonals identify when those relationships are most likely to move. Together, they create a refined high-probability strategy. For example, the November soybean, December corn spread often rises from July to October. Seasonal analysis tells you when. Spread charts tell you how. Wait for both elements to align before entering. This approach turns trading into a process of patient execution, not guesswork. The trader's job is to wait for the right conditions, then manage the trade with discipline. Emotional pressure drops you following a plan, not chasing moves. This is the hallmark of a professional, process-driven trader. Risk management in spreads is more sophisticated than with outright trades. Stops are set on the spread's value, not the underlying contracts, defining risk precisely. Use logical, chart-based stops beyond recent swing points though. Avoid getting stopped out by noise. Position sizing is critical. Base it on dollar risk, not margin requirements. Avoid over-leveraging just because spreads require less margin. Exit trades when the seasonal window closes, even if your stop isn't hit. The edge fades as the window closes. Protect capital for better opportunities. Consistent, disciplined risk management is what separates professionals from amateurs. Maximizing profit in spreads is about consistency, not home runs. Set realistic profit targets based on historical spread behavior. Don't try to capture every last cent. Understand carrying charges and futures curve structure to select spreads with built-in advantages. Scale out of positions to lock in gains and leave room for windfall profits. Focus on meticulous trade selection. Only take high-quality setups with strong seasonals and favorable risk-reward. Patience is key. Wait for A+ opportunities, not frequent trades. This selectivity filters out marginal trades and maximizes long-term profitability. The true path to success is disciplined, high-probability execution. Joe Ross's Trading Spreads and Seasonals teaches a disciplined, process-driven edge for experienced traders. Embrace spread structure for precision and lower risk. Use seasonal analysis to identify recurring windows, but always confirm with current price action. Risk management is paramount. Define risk by the spread, use logical stops, and size positions by dollar risk. Protecting capital is the foundation of long-term success. Integrate spreads and seasonals into a cohesive plan. Wait for high-probability setups. Execute with discipline. This approach adds a powerful, non-correlated strategy to your arsenal. Consistency and control are the hallmarks of a professional trading career.